This is the strangest file on our shelf because the company in it isn't dead. Costco sells a quarter-pound hot dog and a refillable soda for $1.50, the same price it charged in 1985. It sells rotisserie chickens at a loss, on purpose, forever. It marks up groceries so little that the merchandise barely makes money at all. By every rule we've covered on this channel, this company should have been stripped, leveraged, and liquidated decades ago. Instead, it's one of the largest retailers on Earth. So today we're doing something different. The last 3 files were autopsies. This one is the control group, the company that proves the deaths were a choice. Start with the number that breaks people's brains. Costco brings in roughly $250 billion a year in sales. Groceries, TVs, tires, gold bars, a mountain of merchandise. And the profit on all of that merchandise, after costs? Barely anything. Because hiding inside the books is a much smaller number doing almost all of the work. Membership fees. That $65 card in your wallet, $130 if you're an executive member. Membership fees are about 2% of Costco's revenue. 2%. And in fiscal 2024, that 2% generated roughly 2/3 of the company's entire operating profit. In the 2 years before that, it was over 70%. Read that back. The warehouse the size of 4 football fields, the pallets, the forklifts, the 50-pound bags of rice, the entire visible business exists mostly to justify a plastic card. Costco is not a store with a membership. Costco is a membership with a store attached. Once you see that, every weird thing about Costco snaps into focus. Let's walk the aisles. Why are the prices so low? Because Costco literally forbids itself from raising them. There's an internal rule, decades old. No branded product can be marked up more than 14% over cost. Nothing Kirkland can be marked up more than 15%. The average across the store runs around 11%. For comparison, a traditional retailer marks up 25 to 50%. That markup is their entire profit engine. Costco capped its own engine on purpose. Co-founder Jim Sinegal explained why in a quote I think about constantly. He said, "Do you know how tempting it is to make another $7 on a pair of jeans? But once you do it, it's like taking heroin. You can't stop." Sit with that quote because it's the thesis of this entire channel coming out of a founder's mouth. Every company in our first 3 files died of exactly that heroin. The extra markup, the extracted real estate, the fee, the dividend, the buyback. Costco's founders identified the drug and banned it on the premises. Why? Not charity. Strategy. Every dollar Costco doesn't take in markup makes the membership card more obviously worth it. The model runs on a loop. Low prices make members renew, renewals are nearly pure profit, and that profit means Costco doesn't need the markup, which keeps the prices low. Members renew at over 90%, in the US and Canada, around 93%. Software companies would sell their souls for retention like that. Costco gets it by selling cheap eggs. Now the hot dog, because the hot dog is not a joke, it is a monument. $1.50 in 1985, $1.50 today, 40 years, 0 inflation. Adjusted for inflation, that combo should cost over $4. Costco just refuses. When the food court's kosher supplier became a problem in 2009, Costco did not raise the price. It built its own hot dog production under the Kirkland label to protect the $1.50. And when the topic of raising it came up internally, Sinegal's response to his successor became company legend. The printable version is, "If you raise the price of the hot dog, I will kill you. Figure it out." The rotisserie chicken got the same treatment rather than let the $4.99 bird creep up in price. Costco spent hundreds of millions building its own poultry plant in Nebraska. These are not promotions, they are hostages Costco took against its own future greed. Prices so famous that raising them would be a public confession that the model was breaking. Then there's Kirkland Signature, and if you've watched this channel from the start, this is where the file gets personal. Kirkland launched in 1995, named after the Washington town where Costco was headquartered. Today, it does roughly $86 billion a year, nearly a third of everything Costco sells. As a standalone brand, that makes Kirkland bigger than Coca-Cola, bigger than Nike. The biggest consumer brand in America is a store brand. And here's the open secret. Kirkland doesn't own factories for most of that. The products are made by contract manufacturers, frequently the same factories producing the name brands sitting next to them on the shelf, sometimes with the brand's own name printed right on the Kirkland label, like the coffee openly roasted by Starbucks. Same product, different label, and the label is the markup. We're going to dedicate an entire future file to exactly who makes what. Consider this the trailer. And one more member perk that tells you everything. Costco sells gold bars at roughly 2% over the metal's spot price, a margin so thin it's basically a favor. They fly off the shelves, a grocery store moving gold at cost as a loyalty play. That's how far the model goes. So here's the question this file actually exists to answer. Why does Costco get to be like this? Sears had legendary brands. Toys R Us had 20% of an entire market. Red Lobster had 600 restaurants and its own real estate. All of them are gone or gutted. What protected Costco? Part of it is math. The membership annuity means Costco never needs to squeeze, and it can play the long game because the profit shows up before the customer buys anything. When competitors start price wars, they're burning their only profit source. Costco is burning pocket change. But the bigger part is the one this channel cares about. Nobody ever got to run the extraction playbook on it. No leveraged buyout ever loaded it with debt. No owner ever sold the real estate out from under it, and Costco owns most of its land and buildings, on purpose, precisely so no one can. It pays workers famously above retail average, keeps turnover low, and eats the Wall Street criticism about it decade after decade. Analysts have spent 30 years telling Costco to raise markups, charge more for the chicken, squeeze the model just a little. The heroin is right there on the table. The company keeps saying no. That's what makes this the control group. The last three files weren't stories about retail dying or Amazon winning or malls going out of style. Costco is a warehouse from the 1980s selling groceries and buildings, the least futuristic business imaginable, and it's thriving. The difference was never the industry, it was whether the people in charge treated the company as a thing to run or a thing to drain. Red Lobster's owners took the buildings. Toys R Us's owners took the fees. Sears' owner ended up on every side of every deal. Costco's founders capped their own take and welded the cap shut. Same country, same decades, same retail apocalypse. Only one of these companies is selling a $1.50 hot dog like nothing ever happened. So the next time someone tells you a beloved company simply had to die, the market changed, the internet came, nothing could be done. Remember the control group, the one that proves hollow, companies aren't found, they're made. If you want more files like this one, the companies you grew up with and the deals that quietly hollowed them out, or in this case didn't, that's what we do here at the Liquidation Files. The next file is already open. I'll see you in that one.